In 1835, Andrew Jackson paid off the entire national debt of the United States. Every dollar. It is the only time in the history of the modern world that a major country has been completely debt-free. And from that moment forward, a pattern held for nearly 200 years. The pattern was simple. America borrowed during crises, during wars, during depressions, during pandemics, and then it paid the debt down during peacetime, during expansion, during prosperity. Debt went up during the Civil War and came down after it. Debt went up during World War I and came down in the 1920s. Debt peaked at 113% of GDP at the end of World War II and fell to 24% by 1974 as the post-war economy boomed. The pattern was the financial heartbeat of the Republic. Crisis meant borrowing. Recovery meant repayment. And the cycle ensured that the nation's credit remained the strongest on earth for generation after generation. That pattern is now broken. And the break is not temporary. It is structural. It is political. And it is, in the judgment of every major financial institution that has evaluated it, irreversible under current political conditions. The United States now carries debt at 100% of GDP, a level previously reached only at the peak of the most devastating war in human history, World War II. But in 1946, the debt was 100% because the country had just defeated fascism across 2 continents. In 2026, the debt is 100% during peacetime, during an expansion with unemployment at 4% with no existential war to justify it. And instead of beginning the cycle of repayment that followed every previous peak, the trajectory is accelerating upward. The Congressional Budget Office projects public debt will reach 156% of GDP by 2055. There is no post-war peace dividend coming. There is no post-crisis boom coming. There is no fiscal consolidation on any horizon that any credible institution can identify. The 200-year pattern of borrow and repay has been replaced by a pattern of borrow and borrow more. And the reason for the break is not economic. It is political. Both parties, across 4 administrations through 7 Congresses, have chosen to increase debt during every economic condition, expansion and contraction alike. The political system has lost the ability to say no, and that inability is what has broken the pattern that held for 2 centuries. The pattern of fiscal discipline that held from Hamilton through Clinton collapsed in the 21st century, and nobody stopped it. Alexander Hamilton's 1791 financial plan for the United States included the assumption of state debts and the establishment of federal creditworthiness as a national priority. Hamilton understood that the ability to borrow depended on the willingness to repay, and his system worked so well that by 1792, government bonds that had been selling at 15 cents on the dollar were trading at $1.20 on the dollar. From Hamilton through Jackson, through Lincoln, through the 2 Roosevelts, through Eisenhower, through Clinton, the pattern held. Debt rose during emergencies and fell during recovery. The mechanism was bipartisan. Under Republican Calvin Coolidge in the 1920s, national debt was reduced by 1/3. Under Democrat Bill Clinton in the 1990s, the federal government ran budget surpluses for 4 consecutive years, and the debt-to-GDP ratio declined from 49% to 33%. Both parties, at different times in history, demonstrated the capacity for fiscal discipline. That capacity has been extinguished. The debt-to-GDP ratio was 34% in the year 2000. By 2011, it had nearly doubled to 65%, driven by the Bush tax cuts, the wars in Afghanistan and Iraq, and the Medicare Part D expansion, none of which were paid for. The 2008 financial crisis and the COVID pandemic each added trillions more, and the political response to every economic condition, good or bad, has been identical. Borrow more. In a recession, spending increases and revenues fall, and the deficit widens. In an expansion, taxes are cut and spending increases, and the deficit widens. The pattern that was supposed to be cyclical, up during crisis and down during prosperity, has become monotonic, up during crisis and up during prosperity. Former Treasury Secretary Janet Yellen described the current fiscal position in a Brookings speech in January 2026. She noted that the overall federal deficit is roughly 6% of GDP, and that level has never before been realized except during wars and recessions. The United States is running a wartime deficit in peacetime. And the One Big Beautiful Bill Act, passed in July 2025, added approximately $2 trillion in additional costs over 5 years. The IMF published an analysis in its March 2026 Finance and Development Journal titled America's Perilous Fiscal Path, in which it compared the current situation to the post-World War II peak and concluded that unlike in 1946, there is no large peace dividend from reduced defense spending to rescue public finances. Demographic factors are pushing spending even higher through the continuing expansion of old age entitlements, and there seems little prospect of avoiding large deficits and mounting debt. The IMF invoked a line from Ernest Hemingway's The Sun Also Rises, in which a character is asked how he went bankrupt and answers quote one The IMF is comparing the United States to a fictional character going bankrupt, and they published that comparison in their official journal 3 weeks ago. And the numbers beneath the comparison are staggering. Interest payments on the national debt crossed $1 trillion per year in the first quarter of 2025, according to St. Louis Federal Reserve economic data. That is more than the entire defense budget, more than Medicare, roughly equal to Social Security. Interest payments now consume 34% of federal tax revenue. 34 cents of every dollar you pay in federal taxes goes to interest on money the government already borrowed. Not to roads, not to schools, not to veterans, not to national defense, to interest. And Moody's projected that by 2035, interest costs will consume 30% of revenue on a run rate basis, up from approximately 9% just a decade ago, a tripling of the government's most fixed, most non-negotiable expense in a single decade. And the CBO projects that even under the most favorable assumptions, the debt-to-GDP ratio will continue to climb every single year for the next 3 decades, reaching 156% of GDP by 2055. And Janet Yellen noted in her Brookings speech that with a 100% debt-to-GDP ratio, a 1 percentage point increase in the average nominal interest rate on Treasury debt eventually raises net interest costs by roughly 1% of GDP. That is the sensitivity of the debt burden to interest rates. A single percentage point move in rates, which is well within the range of normal market fluctuation, adds hundreds of billions in annual debt service. And if higher debt crowds out private investment and reduces GDP growth, the outcomes are worse. The system has become fragile in a way it has never been in peacetime, and the fragility is the direct consequence of the political decision made by both parties repeatedly over 25 years to abandon the pattern of fiscal discipline that held for 200 years. The 200-year pattern of an independent central bank was broken by a criminal investigation of the Fed chairman. The Federal Reserve was established in 1913 to prevent the kind of financial instability the United States had experienced after the failure of the Knickerbocker Trust. And in 1951, the Treasury Federal Reserve Accord formally established the central bank's independence from political control, insulating it from the kind of pressure that had forced it to suppress interest rates during the World Wars. From 1951 forward, for 74 years, no president successfully interfered with the Fed's rate-setting authority. Presidents complained. Presidents criticized. Richard Nixon pressured Arthur Burns. Lyndon Johnson physically intimidated William McChesney Martin. But no president launched a criminal investigation of the Fed chairman. No president attempted to remove a sitting Fed governor for policy disagreements. No president stated publicly that a litmus test for his Fed nominee was whether the nominee would immediately cut rates on command. All 3 of those things happened in 2025 and 2026. The Department of Justice served the Fed with subpoenas threatening a criminal indictment of Chair Powell over a building renovation. The administration attempted to remove Governor Lisa Cook, and the Supreme Court had to intervene. Stephen Moran was placed on the Fed board while retaining his position as chair of the Council of Economic Advisors on unpaid leave rather than a resignation, and proceeded to dissent from every rate vote in favor of the president's preferred policy. The former chair of the Federal Reserve, Janet Yellen, warned in her January 2026 Brookings speech that the president has vocally demanded that the Fed lower interest rates to levels well below most estimates of neutral, that he has threatened Fed independence by attempting to dismiss a governor, and that he has asserted the right to dismiss Senate-confirmed members of independent agency boards for policy reasons. 3 former Fed chairs, Greenspan, Bernanke, and Yellen, issued a joint statement saying this is how monetary policy is made in emerging markets with weak institutions. And Raghuram Rajan, the former governor of the Reserve Bank of India and one of the most respected monetary economists alive, wrote in Time in January 2026 that if the job of Fed governor entails the choice of subservience to the government against one's professional instincts or being the target of insults, innuendo, and criminal investigations, it is hard to imagine it will continue to attract professionals of the highest caliber. The 200-year trend of building institutional independence, from Hamilton's establishment of federal credit through the creation of the Fed in 1913, through the 1951 Accord, through Volcker's inflation fight, through Greenspan's management of the 1990s boom, through Bernanke's crisis response, has been reversed in 18 months. The institution that took 200 years to build is being dismantled on a political timeline. And the economist Tyler Cowen from George Mason University told Fortune that investors have already accepted the quote, that the Federal Reserve's independence is a relic of a bygone era. The market is not waiting for the formal end of Fed independence. The market has already priced it in. And the consequences of that pricing, higher inflation expectations, a weaker dollar, rising risk premiums on Treasury debt, and reduced foreign demand for dollar-denominated assets are already visible in the data. And there is a historical irony in the physical setting of this confrontation that nobody in the mainstream press has noted with the weight it deserves. The Federal Reserve's headquarters in Washington, D.C., the building that the DOJ investigation into Powell's testimony concerns, is the Marriner Eccles Building. It was named for the Fed chairman who presided over the Treasury Federal Reserve Accord of 1951, the agreement that formally established the central bank's independence from political interference. The Fed moved into that building in 1937 specifically to signal its independence from the Treasury Department, whose building had previously housed the Fed's offices. The criminal investigation that is being used to pressure the current Fed chairman is literally centered on the building that symbolizes the central bank's independence from political pressure. The investigation concerns the renovation of the building that was built to embody the very principle that the investigation is being used to undermine. Eccles himself fought against Treasury interference in monetary policy during and after World War II, arguing that the central bank must be free to pursue price stability even when the government preferred cheap money to finance its spending. That fight produced the 1951 Accord, and the Accord held for 74 years. Until now, the building still stands. The principle it represents is being demolished from the inside. The 108-year pattern of sovereign credit was broken 3 times in 14 years, and the trajectory is toward a 4th. Moody's held a perfect credit rating on the United States since 1917. For 108 years, through every crisis the nation faced, Moody's looked at America's books and concluded that this country pays its debts. S&P maintained its top rating from the agency's founding. Fitch maintained its top rating similarly. The AAA sovereign credit rating was not a formality. It was the financial foundation of the post-war global order. The reason the dollar became the world's reserve currency, the reason Treasury bonds became the global safe haven asset, the reason America could borrow at the lowest rates on earth was that the rating agencies certified, year after year, decade after decade, that the United States was the most credit-worthy borrower in the world. S&P broke the pattern in August 2011, citing the weakening effectiveness, stability, and predictability of American policymaking and political institutions. Fitch broke it in August 2023, citing an erosion of governance. And Moody's broke it on May 16, 2025, citing the increase over more than a decade in government debt and interest payment ratios to levels significantly higher than similarly rated sovereigns and the failure of successive administrations in Congress to reverse the trend. The convergence of 3 independent agencies using different methodologies and different data arriving at the same conclusion over 14 years is not a political statement. It is a professional consensus. And the professional consensus is that American governance has deteriorated to the point where the nation's credit is no longer the best on earth. 10 countries now hold higher ratings than the United States from all 3 agencies. Germany, Switzerland, Singapore, Norway, the Netherlands, Denmark, Sweden, Luxembourg, Australia, Canada, countries whose GDP is a fraction of America's, countries whose military is a fraction of America's, but countries whose political systems are still capable of managing their finances responsibly. The 200-year pattern of building and maintaining the world's strongest credit has been broken, And the Bipartisan Policy Center warned that under current law, public debt is projected to grow between 5.5 and 6% each year over the next decade, much higher than the 4% nominal economic growth that has been the norm this century. When debt grows faster than the economy indefinitely, the trajectory terminates in one of three outcomes: inflation that erodes the real value of the debt, austerity that cuts spending to levels that would cause social upheaval, or default. Those are not political predictions. Those are the mathematical endpoints of a trajectory that every rating agency, every central bank, and every international financial institution has now publicly identified. And the downstream consequences of the broken credit pattern are already visible in the global financial architecture. The dollar's share of global foreign exchange reserves has fallen from 71% in 2000 to approximately 59% today, a 12 percentage point decline that accelerated noticeably after the first S&P downgrade. China has reduced its Treasury holdings from $1.3 trillion in 2013 to approximately $760 billion, a 42% reduction. Central banks in China, India, Russia, Turkey, and Poland have been buying gold at record quantities for 4 consecutive years. Gold recently crossed $4,500 per ounce, roughly tripling in value. The market is repricing the risk of holding dollar-denominated assets in real time, and the repricing accelerates with every downgrade, every debt ceiling standoff, every political interference with the Fed, and every piece of legislation that makes the trajectory worse. The privilege that Alexander Hamilton spent his career building, the privilege of being trusted as the most credit-worthy borrower on earth, is being consumed by a political class that inherited the privilege and is spending it for short-term advantage without any plan to replenish it. That privilege took 200 years to build, and it is being depleted in decades. The 200-year pattern of American democratic governance just recorded its sharpest decline in history, and the data is unambiguous. The Century Foundation published a new United States Democracy Meter in January 2026 that measured the quality of American democracy on a 100-point scale across 23 subcategories. The 2024 baseline score was 79 out of 100, described as mediocre but still solid. The 2025 score was 57 out of 100, a 28% decline in a single year. The biggest collapse was in state institutions, which fell from 22 out of 30 to 10 out of 30. The Century Foundation described the decline as an unprecedented breakdown of the law and the constitutional order in the United States. Freedom House, which has rated the freedom and governance of every country on earth since 1972, lowered the United States score again in its 2026 report, citing the escalation of a multi-year trend of partisan gridlock and dysfunction in Congress, culminating in a funding crisis and the longest government shutdown in U.S. history, as well as a parallel escalation in the executive branch's assertions of unilateral authority. Freedom House documented the issuance of an unprecedented number of executive orders, many of which appeared to conflict with existing law, and the assumption of spending and oversight responsibilities that the Constitution assigns to Congress. The Carnegie Endowment for International Peace published a comparative analysis of U.S. democratic backsliding in December 2025 that placed the United States alongside Hungary, Turkey, India, and El Salvador in its framework of executive aggrandizement. Carnegie noted that even in comparison to similar cases like Poland and Hungary, Trump's actions reflect an unusually condensed timeline and rapid upending of democratic norms. The authors of How Democracies Die, political scientists Stephen Levitsky and Daniel Ziblatt, identified 2 norms that preserved American democracy for most of its history: mutual toleration, the understanding that competing parties accept one another as legitimate rivals, and forbearance, the idea that politicians exercise restraint in deploying their institutional prerogatives. Both norms, they argued, had eroded steadily since the 1990s and had been abandoned entirely by one major party by 2025. The 200-year pattern of democratic governance that Levitsky and Ziblatt described, a pattern built on informal norms rather than constitutional text, held because politicians of both parties chose not to use the full extent of their power to destroy their opponents. That restraint is gone, and the absence of restraint is the absence of the pattern. The guardrails, as Levitsky and Ziblatt called them, are no longer functioning, and the political system that is supposed to manage the economy, set fiscal policy, maintain credit, and preserve institutional independence is itself degrading faster than any of the economic indicators it is supposed to manage. The 200-year pattern of American population growth that powered the economy is breaking and may reverse for the first time in history. The United States has grown in population every single year since the first census was conducted in 1790. 236 years of continuous population growth. It is one of the most durable demographic patterns in the history of any nation. That pattern powered the American economy because population growth means more workers, more consumers, more taxpayers, more demand for housing, more demand for goods and services, and a larger base over which the national debt can be spread. Every economic projection, every Social Security actuarial table, every pension fund assumption, every corporate growth model in America is built on the assumption that the population will continue to grow. Bloomberg reported in 2025 that the United States may see its first population decline in 2026. Net migration, which has historically supplemented natural population growth, turned negative for the first time since the Great Depression. Birth rates have fallen to the lowest levels ever recorded. 7 in 10 Americans told pollsters in 2025 that raising a child is unaffordable, up from 58% a year earlier. The cost of housing, healthcare, childcare, and education has pushed the decision to have children from a personal choice into a financial calculation that an increasing number of American families are answering with no. And immigration policy has simultaneously shifted toward restriction at the exact moment that the economy needs immigration most, because the native-born working-age population is shrinking as the baby boomers retire at a rate of 10,000 per day. The pattern of perpetual population growth powered the post-war economic miracle, the suburban expansion, the consumer economy, the housing market, the university system, and the tax base that funded every government program from Social Security to national defense. If that pattern breaks, and Bloomberg's reporting suggests it may break this year, the consequences cascade through every economic model that assumed it would continue. Social Security's trust fund depletion date, already projected for 2032 or 2033, would accelerate. The housing market, which depends on new household formation, would structurally weaken. The labor force, which needs young workers to replace retirees, would shrink. And the GDP growth rate that is supposed to outpace the growth rate of the debt, which is the only mathematical scenario in which the debt trajectory stabilizes without either austerity or inflation, would decline permanently. The population growth pattern is the foundation beneath all the other patterns, and if it breaks, nothing built on top of it holds. What happens when all 5 patterns break at the same time in the same country? No major developed country in the modern era has experienced the simultaneous failure of all 5 of these patterns. Fiscal discipline breaking, central bank independence breaking, sovereign credit breaking, democratic governance degrading, and population growth reversing. These are not independent variables. They are interconnected in ways that amplify each other's damage. When fiscal discipline breaks, debt grows. When debt grows, the pressure to politicize the central bank increases because the executive wants lower rates to reduce debt service costs. When the central bank loses independence, inflation expectations rise. When inflation expectations rise, the rating agencies downgrade the country because inflation erodes the real value of the bonds they are rating. When the country is downgraded, borrowing costs rise, which makes the deficit worse, which increases the pressure on the central bank, which further erodes credibility. The loop is self-reinforcing, and at the center of the loop is the political system, which is supposed to be the mechanism through which the country course corrects. But the political system is itself degrading. The democratic norms that enabled bipartisan fiscal agreements, that respected institutional independence, that accepted electoral outcomes and governed with restraint are the norms that Levitsky, Ziblatt, the Century Foundation, Freedom House, and the Carnegie Endowment have all documented as collapsing. The correction mechanism is broken. The loop has no break. And the population decline, if it materializes, removes the last organic growth engine that could have generated the revenue needed to grow the country out of the debt trajectory without austerity or inflation. Ray Dalio, the founder of Bridgewater Associates and one of the most influential investors of the past 50 years, has written extensively about the cyclical rise and fall of great powers. His framework identifies declining education, rising inequality, internal political conflict, growing debt, and loss of reserve currency status as the markers of imperial decline. He has explicitly applied this framework to the United States in recent years, arguing that the combination of extreme inequality, unsustainable debt, and political polarization mirrors the late stages of previous global powers, including the Dutch, the British, and the Spanish empires. Peter Turchin, the quantitative historian who has spent decades studying the mathematical patterns of societal collapse, predicted in 2010 that the United States would enter a decade of turmoil starting in 2020. His model, which is based on 5,000 years of data from societies around the world, identifies three drivers of collapse: growing wealth disparities, a surplus of educated elites competing for limited opportunities, and declining public trust in institutions. All three of those conditions are present in the United States in 2026 at historically extreme levels. Turchin's model does not predict the specific form of the collapse. It predicts the timing and the conditions, and the timing aligns precisely with the pattern breaks I have described in this video. The fiscal pattern broke in the 2000s. The credit pattern broke between 2011 and 2025. The central bank independence pattern broke in 2025 and 2026. The democratic governance pattern recorded its sharpest decline in 2025. And the population pattern may break in 2026. 5 patterns built over 200 years breaking within a single generation. And the people who built their lives, their retirements, their savings, their careers, and their families on the assumption that those patterns would hold are now discovering, one data point at a time, that the foundation has shifted. The question is not whether the foundation has shifted. The data is unambiguous. The question is how far it shifts before the structures built on top of it begin to visibly fail. And the answer to that question will be written in the next 12 to 24 months, in the CPI reports, in the GDP data, in the credit rating watches, in the Fed's decisions, in the midterm election results, and in the census data that will confirm or deny whether the United States just became the first major developed country to lose population growth in peacetime while carrying debt at 100% of GDP with a downgraded credit rating, a politically captured central bank, and a democratic governance score that fell 28% in a single year. Nobody alive has seen this combination before. Not in this country. Not in any country this wealthy. Not in any country this powerful. And the patterns that held for 200 years held because they were reinforced by norms, by institutions, by bipartisan agreement, and by the simple political arithmetic that breaking them would cost more than maintaining them. That arithmetic has changed. Breaking the patterns is now cheaper politically than maintaining them. And that is the most terrifying sentence in this entire video, because it means the breaks are not accidental. They are chosen, and the choices that broke 200 years of precedent were made by people who calculated that they would benefit from the breaking. And they were right. They did benefit. The cost was distributed to everyone else. To every American who holds dollars. To every American who depends on institutions. To every American who trusted that the patterns would hold because they had always held. The patterns held because they were defended. They broke because they were abandoned. And what comes next is whatever happens to a country when 200 years of accumulated institutional capital is spent in a single political cycle by people who will be gone before the bill arrives. And I want to be specific about what the bill looks like for ordinary Americans, because the abstract language of institutional decline and pattern breaks can obscure the concrete reality of what these changes mean for the person watching this video right now. When fiscal discipline breaks, the government borrows more. When the government borrows more, Treasury yields rise. When Treasury yields rise, your mortgage rate rises, your auto loan rate rises, your credit card APR rises, and every business in America pays more to borrow, which means they hire less, expand less, and raise prices more. When the central bank loses independence and cuts rates under political pressure despite elevated inflation, the dollar loses value. When the dollar loses value, the price of every imported good rises, which means your grocery bill, your gasoline, your clothing, your electronics, and your medications all cost more. When the credit rating falls, foreign investors demand higher returns to hold U.S. debt, which pushes yields higher, which pushes your borrowing costs higher still. When democratic governance degrades, the political system loses the capacity to address any of these problems because compromise is impossible. Long-term planning is impossible, and every policy decision is made for short-term political advantage rather than systemic stability. And when population growth reverses, the economy loses the organic growth engine that was supposed to generate the revenue to service the debt, fund the entitlements, and support the consumer spending that drives 70% of GDP. Every one of these pattern breaks translates directly into a number on your mortgage statement, your grocery receipt, your insurance premium, your utility bill, your tax return, and your retirement account balance. The patterns were not abstractions. They were the invisible architecture that made middle-class life in America financially viable. And as that architecture crumbles, the financial viability of the life you were promised, the life you built, the life you are trying to maintain, crumbles with it. Not because of your decisions, because of theirs. Because of the decisions made by the people who calculated that breaking 200 years of precedent would benefit them personally and politically, and who were correct in that calculation, and who will never bear the cost of being correct. The politicians who broke the fiscal pattern will retire on government pensions that are inflation-adjusted. The executives who lobbied for the tax cuts that widened the deficit will hold assets denominated in currencies and commodities that hedge against dollar decline. The appointees who captured the Fed will move into private sector positions at firms that profited from the volatility their appointments created. And the ordinary American who did everything right, who worked, who saved, who paid taxes, who trusted the institutions, who believed the patterns would hold because they had always held, will bear the full weight of the cost in their mortgage payment, in their grocery bill, in their retirement account, in their purchasing power, in the value of the dollars they spent a lifetime earning and a political class spent a single cycle destroying. That is what it means when a 200-year pattern breaks. It does not mean a number changes on a chart. It means the rules that governed your financial life for your entire lifetime no longer apply. And the new rules have not been written yet. They are being written right now by the people who broke the old ones, and nobody asked you.